India's CPI for the month of May has come below estimates at 4.25%. Food price inflation has come at 2.9% versus 3.8% in April, while CPI rural inflation has come at 4.17% versus 4.68% in April. Let's welcome on board Saugata Bhattacharya, Chief Economist, Axis Bank, and Madan, Chief Economist, Bank of Baroda. Good evening and welcome to the show. Let's talk about CPI, and we also have the IIP data that's come out at 4.2%, which is again a good number. But then CPI, Saugata, it's come down to what, 25-month low? Is that what even you were expecting?
Yes. Hi, Kavita. So we were definitely, our forecast was 4.27%. We just barely missed it. So it's coming in essentially from food prices and a lot of it from some vegetables components. A little bit we had also expected from the miscellaneous component of the core inflation, which is led by gold. But that's a small. What I need to now see is, and this is definitely one of the lower, because I mean this is the base effect. I mean this is a base effect of the May inflation of last year. What we now need to see is the core inflation, which we had forecasted about 5.2. That's not coming off very significantly. So that's a little bit of a worry. But otherwise, inflation is on track to be sub 5% for the next 4 or 5 months at least.
Madan, if I just get you the breakup, cereals up 12.7%, milk up 8.9%, oils down by 16%, vegetables down 8%, spices up 18%, and personal care up 10%. Do you think cereals coming up at around 12.7%, is that a concern? Madan? I think you're on mute. I'm sorry. I think you're on mute.
Sorry. Yeah, I think that is definitely a concern when we're talking of cereals inflation being high, because we had seen that even last year, on account of the wheat crop being affected by extreme heat conditions, we had seen prices going up. Output was also lower. This year, we have seen that even prices of rice has gone up in the market. So both rice and wheat are the pressure points which we're seeing. Add to this the fact that you've not mentioned pulses, but I think in pulses inflation has been over 6%. And this is something which is increasing. So I think when we're talking of El Nino and the possible impact it may have on the Kharif output, where cereals as well as pulses are the ones which are covered, I think that is something which will be of concern both for the government as well as the Reserve Bank of India. Because most of the forecasts of inflation, which appears to be very much on target with what the RBI has forecast for the first quarter being low, will probably happen in case we have a normal monsoon. But any kind of El Nino impact affecting the Kharif crop will definitely have a negative impact. So I think that is something which we need to be watchful of. We've already seen prices like of milk has gone up. Same thing holds for spices. So I think the factors which have been pushing it up remain up. And I think components like edible oils as well as vegetables are the ones which are actually dragging it down. So I think that's something which is probably going to continue. So I think the monsoon will hold the clue for future direction of food inflation.
The monsoon trajectory is definitely a very important trigger, but then I also want to break down, Saugata, the IIP data that's coming in, 4.7% versus 6.7% year on year. Now, mining sector growth is at 5.1%. That's again a year-on-year number that we are giving you. Manufacturing is at 4.9%. Electricity is minus 1.1%. Consumer durable output has come down to minus 3.5%. Infra goods output has come at 12.8%. Capital goods has come at 6.2%. How is this data looking as, again, on expected lines, is it?
No, very hard to admit this. We were very wrong. We were about 1.5%. So the extra growth seems to have come in from consumer non-durables, which is the FMCG segment. Most of the others are more or less on track. So this does show that the fears, particularly from the rural segment, of a fairly weak consumption trend in the last couple of months, that now seems not to have actually happened. FMCG sales, which is the consumer non-durables part, besides all the other infrastructure, capital goods, etc., that you're mentioning, those were expected to be robust. Electricity, of course, because of the unseasonal rains in the month of April, we had expected electricity demand to have been weak. But overall, I think this is a fairly good growth inflation mix, that consumer goods demand seems to be relatively strong, relatively resilient. Whereas although core inflation is probably still sticky, overall inflation is coming down. So the two paired together paints a fairly good, a comforting picture of the economy.
And do you think, Madan, do you think this comforting picture will be sustaining for a longer period of time? We know that for inflation, monsoon is a very important trigger. But what about the rural demand? And rural inflation also, I think, has come down to 4.17, which is like a very marginal thing. But how do you look at few more quarters, looking at the way monsoon is actually creating issues?
See, as far as inflation is concerned, I think we will continue in this particular direction. So I don't think there's going to be any pressure coming on the inflation front. But I think what we need to be a bit more careful about is how the IIP numbers are going to behave. To my mind, it's happening more on account of a single month impact, which is there. There's also a base effect, which is involved. Because we should remember one thing, that this is not a time when typically demand picks up. So unlike, I have a slightly different view from Saugata out here, because when I look at the FMCG goods and I see the way in which they have performed, I would rather wait for another couple of months to see if it's actually sustained out there. The same thing holds also for things like capital goods, because we've seen even in the past that in a single month, when we try and interpret the number as being a kind of a recovery, is not really sustained. So ideally, I think we'll have to wait for another 2 months. That is, we'll have to see how the Q1 performance of industry is before we can conclude that something really is happening. Because similar to what Saugata was saying, we were actually looking at an IIP growth number even lower at around 1.2%. So 1.2 coming in now at 4.2 has been definitely a kind of a pleasant surprise. And I would say to an extent it becomes a bit difficult to believe, because with the kind of buoyancy we're seeing in capital goods, we're seeing in FMCG, it's not something which we had actually envisaged. And also, if I look in terms of whether investment is taking place on the private sector's front, not seeing too many signs of it. And it's early days. Investment never really happens in the months of April, May, June. It's more likely to happen post monsoon. So I think the base effects, statistical effects, have been playing a bigger role. So while definitely it's a good sign to say that inflation coming down, growth probably still on target, I would probably wait for another couple of months before I can draw firm conclusions.
Are we on track for RBI's 4% inflation target? Looking at this data, Saugata?
Hi. 4% inflation target for this quarter, you mean?
For RBI, the number that's set by RBI.
Right. So I believe we are.
Okay.
As Madan mentioned, of course, I mean, there is the risk of an El Nino-induced poor rains, but that will probably show up more towards the end of the quarter. I mean, we have already got the May number. So April and May together combined is about 4.5, let's say. Over that, we probably will get another a number which is close to these numbers. These are preliminary, of course, in the month of June. So we should be on track for an average 4.5, 4.6% for this quarter. My sense is that overall for the year, of course, this is provided that the rains don't disrupt food prices significantly in this Kharif season. So given that, and the fact that we probably are likely to get a cut in petrol, diesel, and other fuel prices somewhere down the line in this year, my sense is that the RBI's 5.1% average forecast for CPI inflation is likely to come in even lower. We are now currently at 4.8. So let's see how this moves up. But together with this, the other fact that we need to be very, very careful about is WPI inflation, inputs costs. Input costs have come down very significantly. We expect WPI inflation to be about 1.5 to 1.6% average for this year. How those input prices are passed on to end consumers will also have a determining factor in how CPI prints begin to shape up over the course of the year.
All right. So, Madan, now what will be the interest rate trajectory for RBI? Do we see a pause being extended further? We have the Fed's interest rate announcements also this week. But then what's the tone for us?
No, I think there will be a prolonged pause. In fact, earlier, before this particular policy, we were thinking that maybe in October or so, there could be a rate cut. But I think going by the commentary, I think it's going to be much later, probably in the fourth quarter, provided the number of 5.1%, which RBI is talking of, takes place. Because if you look at the quarterly forecast, which the RBI has given for inflation, it's actually going to peak at 5.4% in the third quarter. So when inflation number moves from less than 5% to 5.2 to 5.4%, it'll be hard for the RBI to cut interest rates at that point of time. So therefore, I think the earliest will probably be in the fourth quarter, that is in the February policy, if at all the number goes around 5.1. But our forecast is that inflation is more likely to be 5.2, 5.3%. So we are much higher than what Saugata is talking of, because we feel that core inflation is something which is likely to pick up, because we feel that a number of companies are still in the process of passing on the higher input costs, and that is something which will get manifested during the course of the year. So as you mentioned, things like your consumer care, your personal care goods, household goods, they've all been showing high inflation. So I think that is still work in progress. And at some point of time, we will see that show up in the inflation numbers. So anyway, a direct answer to your question, fourth quarter is the earliest when we could see a rate cut, not before that.
All right, fourth quarter is the earliest we could see a rate cut. Saugata, quickly, your view on the same lines?
I agree with Madan that before the fourth quarter, before the February policy, it's very, very unlikely. In fact, I mean, if you think about it, if the RBI's growth forecast of 6.5, and we are now very close to it at 6.4 average for the year, if that actually happens, if there is really no case for a rate cut. If these strong prints and a sticky core inflation continues for the next few months at least, they will probably not be able to make any significant, meaningful cuts. And remember, this also depends. The rate cut in India also depends, because the differential between the federal funds rate and the RBI repo rate is now very, very small. So unless the Fed begins to start cutting, and markets are already pricing in a much weaker set of rate cuts from the Fed, that even RBI will be constrained by how much and when the Fed actually cuts its federal funds rate. So given these conditions, if at all, there will be a shallow 25 basis point rate cut in the fourth quarter in February. But even that it's very, very early to predict at this point in time.
We'll have to see how the events actually shape up. But then so far, it is so far so good. That's a picture looking like inflation cooling down to 25-month low, and factory activity is picking up. Thank you so much, Madan and Saugata, for being on the show and helping our viewers understand this very important data. On that note, it's a wrap. Thank you so much for watching. Goodbye.